Good morning and welcome to the Killik and Co market update. This week, a report has been published about global warming and the need to reduce carbon emissions. The message itself is certainly not new, but the report was particularly powerful because it was published by the IPCC, which is the United Nations Intergovernmental Panel on Climate Change. And this is a group of scientists whose findings are endorsed by world governments. And this was in fact the first major review of the science behind climate change since 2013. And sadly, the report did say that the situation has gotten notably worse since then. Really, there were three key findings from the report. The first was that the situation has got quite a lot worse since the last review in 2013. The second was that humans are almost certainly to blame for global warming. And the third was that it's not too late to limit the damage of global warming as long as major action is taken sooner rather than later. Here's one of the most interesting charts that we took from this report, and it shows the annual change in global surface temperature going all the way back to 1850. That beige line shows the actual change that has occurred, including the impact of humans, and that sort of greeny blue line shows a simulated estimate of the change that would have occurred without the impact of humans. So you can see in that scenario, there would virtually be no global warming whatsoever. This report has had quite a lot of press over the last few days, and it's likely to renew the focus on green energy stocks, one example being Ørsted, the Danish wind farm company, whose shares are currently trading quite far below their record high. Do give us a call if you'd like to talk about these types of stocks in a bit more detail. The UK economy grew 4.8% in the second quarter of this year, with the entertainment and accommodation industries putting in a particularly strong performance following the lifting of some coronavirus restrictions, and no doubt the Euro 2020 football tournament helped as well. The UK economy is now about 4% smaller than it was before the pandemic. However, these latest growth numbers will not contain the growth that has happened since Freedom Day, which was on July the 19th, and it is hoped that further amounts of growth have happened in the UK since restrictions were almost entirely lifted on this date. If we have a look at the stock market, it does imply that there is a certain degree of optimism about the UK's prospects. While the FTSE 100 index is very international, and for that reason it's arguably not a particularly good barometer of the UK's economic fortunes, a lot of economists do view the FTSE 250 as a much better measure of what's going on in the UK. The reason being the index contains a lot of smaller companies that are more domestically focused. So here's a chart comparing the FTSE 100 with the FTSE 250 over the last 2 years. And you can see that the FTSE 250 is currently trading above its pre-pandemic level. So bearing in mind that stock markets tend to be forward-looking, this does imply that a number of investors are feeling quite positive about the UK economy at the moment. The Chinese Communist Party released a new 5-year plan this week, outlining its desire to exert a greater level of regulatory control over key sectors such as education and technology. In particular, the party wants to increase social mobility by making access to things like education more affordable, and it also wants to crack down on companies with perceived monopoly power. In this video a couple of weeks ago, we talked about the sudden ban on private tutoring companies in China being allowed to make a profit, and that led to some share price falls of 90% almost overnight. So concern over this uncertain regulation in China is making the country increasingly difficult to invest in. And we can see this by looking at the MSCI Golden Dragon Index, which tracks the performance of companies in China, Taiwan and Hong Kong. As you can see, the index has sold off quite heavily over the last few months, as investors have become increasingly worried about this increased activity by the regulator in China. It's certainly true that China is still growing very quickly, but anyone with a very high level of Chinese stocks in their portfolio would certainly be taking on quite a high level of risk. Moving on to have a look at next week, we're expecting results out from Chinese tech giant Tencent, digital payments company Adyen, and cosmetics giant Estee Lauder. That's it from us. Enjoy the weekend, and we'll see you next Friday.